Welcome to the Deep Dive, your shortcut to being well-informed. This week, we're diving into what looks like a really pivotal period for global markets. We're covering June 29th to July 6th, 2025. Our mission today: sift through the macro landscape from our sources, pull out the most important nuggets for you. Think of this week as a critical stress test. Can the U.S. keep up its, surprising resilience? Or will those whispers of disinflation in Europe get louder? And then there's this massive hidden market bet hanging over everything. Could be spectacularly right or, painfully wrong.
That's absolutely right. For you, the listener, the week ahead really boils down to three main themes, all kind of interconnected. First, you've got that crucial job and inflation data, U.S., Eurozone. That could really shift central bank thinking dramatically. Second, we need to look at the key global growth barometers. How are the big economies actually doing? And finally, this fascinating, maybe volatile imbalance in market positioning. It's really quite stark. Any one of these, or, all of them together, could trigger some major shifts, especially in the FX market.
Okay, let's unpack those core drivers then.
Yeah.
Starting with what our sources are calling the cross-Atlantic data battle.
Yeah.
So we're zooming in on US Non-Farm Payrolls, NFP, and the Eurozone flash CPI. Why these two? Why are they the most important pillars this week?
Well, they're basically the real-world test for two very different economic stories right now. You've got the narrative of the, still remarkably robust U.S. economy on one side. And on the other, these growing signs maybe of deflationary pressures popping up in Europe. So the NFP and the Eurozone CPI, they'll directly impact whether the Fed and the ECB stick to their current plans, or if they, need to change course, maybe hit the brakes, maybe even reverse.
Right, so their interest rate decisions hang in the balance, and that affects everything.
Exactly.
Everything.
Okay, so if that's the Atlantic battle, what about the global picture? Let's look at these global growth barometers. How do the OPEC Plus meeting coming up and China's PMI data fit in? How do they help us gauge global risk sentiment? Yeah, these are essentially the world's economic health checks, you could say. Huh. OPEC Plus decision on oil production. That directly hits global crude prices, and that feeds straight into inflation everywhere.
So higher or lower prices at the pump for you, the listener. Mm-hmm. And ripple effects beyond that.
Precisely. And then China's PMI data, that's a direct look at the health of the global growth engine. China's the world's factory, right? A huge consumer. If they slow down, it sends ripples through trade. And that really hits commodity currencies hard, like the Aussie dollar, the Canadian dollar. They're tied so closely to global demand.
Okay, and this leads us to where it gets, really interesting. As you said, our sources flag the coiled spring of market positioning, this hidden factor. A huge difference in what the big market players are betting on. Recent data shows extreme net short positions in the U.S. dollar, a 6-month low.
Yeah, hitting a 6-month low. So essentially a massive bet that the U.S. dollar is going down. It really is a coiled spring scenario. Think about it. The market's coming into the week with these totally conflicting signals. You've got recent U.S. data, like PMIs, looking pretty decent, suggests the U.S. still has some leadership globally. But other indicators, economic surprise indicators, show things are slowing.
Right, a mixed picture.
Exactly. But despite that, market sentiment is just overwhelmingly betting on a USD decline. Now, this lack of consensus, this lopsided positioning, it means the upcoming data, especially NFP, becomes this incredibly powerful catalyst. If that big market bet turns out to be wrong, all that pent-up energy could just explode. An outsized price move. It could force a massive liquidation of those short dollar positions. It's a classic setup for a surprise, really.
That coiled spring idea is powerful.
Yeah.
In your experience, what's the biggest mistake people make when they see this kind of extreme positioning? How do you avoid getting caught?
Well, the biggest mistake is just assuming the crowd must be right, or thinking, it'll unwind slowly. When positioning is this skewed, the pain trade, the move that hurts the most people, can be incredibly fast and severe.
Ouch. Yeah. You avoid getting caught by understanding that this extreme positioning makes the market super sensitive to even small surprises. It means you need to be extra careful. Don't just follow the herd. Think about how they might be forced to react if the data cuts the other way.
Okay, let's dive a bit deeper then. Beyond the numbers, what's the general market psychology, the fear and greed pulse?
Well, if we look at the VIX, the CBOE volatility index, the fear index as it's often called, it's sitting around 16.32. Now, that's down from recent highs, above 20 back in mid-June. So it suggests things have calmed down, maybe even a bit of complacency creeping in.
Complacency before a big data week.
Could be the calm before the storm, absolutely. And we also need to keep an eye on the V index. That's like the VIX, but for the bond market. Any sudden spike there would signal growing uncertainty about interest rates. And that's a direct risk for the dollar and, broader sentiment too.
So VIX, calm, movie, stable. What does that tell us overall? Well, the CNN Fear and Greed Index, which is a broader measure, it's currently neutral. Historically, extreme readings there often signal reversal. So neutral suggests the market's kind of balanced, waiting.
Just waiting for a clear signal.
Exactly. It just reinforces how critical this upcoming data is. It's going to break the deadlock, push sentiment one way or the other.
Okay, now for the really juicy stuff. The CFTC Commitment of Traders Report. This is like looking at the big players' poker hands, right? Hedge funds, institutions.
Precisely. It shows us where the quote-unquote smart money is placing its bets based on data up to June 24th. And the picture is pretty clear. For the US dollar index, the DXY, large speculators are net short, minus 2,968 contracts.
And that's the most pessimistic in.
Nearly 6 months. It's a big bet, really, on a dovish Fed and a weaker dollar going forward. But conversely, look at the euro. Speculators are increasing their net longs, up to 111,100 contracts. That shows pretty strong confidence in the euro's recovery story.
Interesting contrast. And crude oil.
Crude oil net longs increased just slightly, up to 233,000 contracts. So maybe cautious optimism there ahead of that OPEC Plus meeting. But the really profound implication here, especially for Euro USD, is this high asymmetric risk profile.
Asymmetric risk. Meaning?
I mean, the potential fallout is much bigger on one side than the other. You've got these extreme USD shorts and crowded Euro longs all bunched together. This makes the trade incredibly vulnerable if the story suddenly shifts. Imagine, for example, a stronger than expected NFP report. That could just shatter the consensus that the Fed has to cut rates soon.
Right.
And that forces a massive short squeeze in the dollar. Everyone who bet against it scrambles to buy it back. At the same time, those long euro positions get liquidated. The result, potentially a very strong US dollar rally. And what's fascinating, or maybe worrying depending on your position, is that the most painful trade for the market right now is a strengthening dollar. A lot of people could get caught offside.
Okay, makes sense. Let's walk through the key events week by week then, starting with the absolute monster on the calendar.
Yeah. Number one, no question. US Non-Farm Payrolls, NFP. Thursday, July 3rd, 7.30 m Vietnam time. Importance, extremely high. This report is going to reshape Fed policy expectations for Q3. It'll largely dictate the dollar's path. Market forecast is for about 120,000 jobs created in June. That's down a bit from 139,000 in May. Average hourly earnings expected to cool slightly, 0.3% month on month. Unemployment holding at 4.2%. But crucially, remember, May's report had those big downward revisions to March and April.
Yeah, about 95,000 jobs wiped off.
Exactly, which suggests that cooling trend might already be happening under the surface. Now, market impact. The CME FedWatch tool, which tracks rate expectations, shows over 50% probability for a third Fed cut this year. September cut looks almost baked in.
So the market's already leaning that way.
Heavily. So if we get a bullish USD scenario, say NFP above 150K, average hourly earnings above 0.3%, that directly challenges the whole dovish Fed story. It shows the labor market is still hot, rate cut expectations would get slashed, and you'd likely see that strong USD short squeeze we talked about.
And the opposite.
A bearish USD scenario, NFP below 100K, earnings below 0.3%, that would just solidify those rate cut bets. Put the dollar under pressure. Though, as we said, with USD longs so crowded, the upside there might be capped, oddly enough.
And if it's mixed, kind of in the middle.
Probably initial volatility, maybe choppy trading, then focus quickly shifts to the next big data point, likely inflation. And quickly, for the chart watchers out there, technically, Eurozone is up near multi-year highs. It's facing pretty significant resistance. Think Fibonacci levels, that sort of thing. Key support to watch. 1.1570 and especially 1.150. That's a big psychological and technical level. USD JPY showing some weakness near 148.00 to 148.50 resistance, with support down around 145.47 and 144.0.
Okay, Clay, what's next on the hit list?
Next up is the Eurozone Flash CPI. That's Tuesday, July 1st, 4.00 p.m. Vietnam time. Importance here is HIGH, key input for the ECB's next move. Forecast for headline inflation, HICP, is 2.0% year-on-year, right back on the ECB's target. But we really need to watch the core HICP that strips out energy and food. Forecast is 2.3% year-on-year. Gives a better sense of underlying pressures.
Right. In context, May's data dipped below 2% for the first time in a while, right? Driven by services cooling off.
Exactly. Headline dropped below 2% for the first time since September 2024. Services inflation cooled, but it's still a big driver. Remember, the ECB cut rates in June, but then kind of signaled a pause. The market, though, is pricing in another ECB cut for September.
So the data could challenge that.
Potentially. A bullish euro scenario core CPI surprisingly strong, say above 2.4%, suggests those underlying price pressures are sticky. That would reduce expectations for a September cut, supporting the euro. On the flip side, a bearish euro scenario core CPI weaker, maybe below 2.2%, reinforces that disinflation trend, makes further cuts more likely, pressures the euro, especially if it lands alongside a strong US NFP report. That would be a double whammy for USD.
Got it. And volatility.
Yeah, USD 1 week implied volatility is up around 8.1%. That's higher than the historical average, so the options market is definitely expecting bigger than usual swings this week.
Okay, moving on. OPEC Plus meeting. Sunday, July 6th.
Yep, high GH importance. Direct impact on crude oil, global inflation, and those commodity currencies we mentioned. They're expected to increase production by about 411,000 barrels per day in August. Part of a gradual plan. But, and this is key, they have a clause giving them flexibility to pause or reverse if market conditions change. Compliance from members like Iraq and Kazakhstan is also something to watch. Brent crude is currently, $64, $67 a barrel?
So what are the possible outcomes?
Well, if they do as expected, probably a mild impact. If they decide on a larger increase, that would be bearish for oil prices. But if they decide to pause the increases, that would likely be bullish for oil, support CAD and NOK, but also maybe reignite some inflation worries.
Right. Okay, what else is high impact? The US ISM PMIs.
Yep.
Manufacturing on July 1st, services on July 3rd. Also high GH importance. These give you an early, broad look at U.S. economic health. And you really want to watch the subcomponents, prices paid and employment. Key clues for inflation and NFP. What are the forecasts?
Manufacturing is forecast at 48.8, still in contraction territory. Services at 50.3, so slowing expansion. ISM itself actually predicts the U.S. economy will be nearly flat for the rest of 2025.
So if growth is slowing but prices paid stay high.
That's the potential stagflation-light dilemma for the Fed. Slowing growth normally means rate cuts, but high prices make that tricky. It could actually support the dollar in that scenario.
Okay. And China's PMI.
China kicks in manufacturing PMI Tuesday, July 1st. Also high GH importance, mainly for global risk sentiment. Remember, May's data was a surprise drop to 48.3, contraction, lowest since September 2022.
Yeah, that spooked markets a bit.
It did. June forecast is 49.0, still contraction. The Aussie dollar often trades as a proxy for China, so weak data tends to pressure the AUD. But if we get a surprising recovery, say back above 50, that would be a real sentiment booster for risk assets globally.
Okay, that covers the big hitters. Let's quickly touch on the rest of the calendar. What else should be on our radar?
Sure. Keep an ear out for ECB President Lagarde speaking on Monday and Tuesday. Any hints on future policy, services inflation, maybe how open that door really is for a September cut.
Then UK data on Monday.
Yeah, UK Q1, final GDP, and current account. Always potential for GBP volatility if there are unexpected revisions. The Bank of England is definitely leaning towards easing. 3 members voted for a cut last time.
Japan Tankan survey also Monday.
Right. Big business confidence survey. Key for the Bank of Japan. If it's weak, it might mean less pressure for them to tighten policy, potentially weakening the yen further.
Okay. And the BRICS Plus summit over the weekend.
Low short-term market impact, probably, but watch it for the long-term trends, geopolitics, macro shifts, especially anything around de-dollarization themes.
Gotcha. And finally, Fed speakers before the blackout.
Yeah, last chance to hear from the Fed before their silent period. Bostic and Goolsbee speak Monday. They're generally seen as neutral to dovish, so if they were to sound unexpectedly hawkish, that could give the dollar some early support heading into the big data week.
Okay, that's a lot to track. Let's try and bring it all together for you, the listener. How can you actually use all this information to navigate the week?
Yeah, it's a ton of info. We've put together what we call an impact matrix. Think of it like a heat map. It helps you quickly spot the volatility hotspots for specific currency pairs or assets you might be watching.
So, for example,
Like if you trade AUD USD, the matrix instantly shows China PMI and US NFP as the highest risk events for that pair. It helps you focus your attention and know when to be most ready for potential big moves.
okay, useful. And what about specific trading ideas or playbooks based on how the data might fall?
Right. Based on the analysis, here are a couple of potential scenarios just as examples for you to consider. Idea 1. Maybe selling EURUSD if US NFP comes in strong and Eurozone core CPI is weak.
The double shock scenario.
Exactly. Clear policy divergence, hawkish Fed, dovish ECB. That's the setup for that potential strong USD short squeeze. Conditions might be NFP over 150K and Eurozone core CPI at or below 2.2%. Entry could be selling if USD breaks and closes below that key 1.1500 level. Stop loss may be above nearby resistance like 1.15880. First target zone around 1.1360, 1.1400.
Okay, that's one idea. Another one?
Idea 2. Potentially buying AUUSD if that China Caixin PMI delivers a big upside surprise. The logic is a strong recovery sign from China, say PMI back above 50.5, would challenge the current gloom, boost risk appetite, and strongly support the Aussie. Entry might be after the data, confirming an uptrend on a shorter time frame like the 1-hour chart. Stop loss below the low formed just before the news. Take profit near technical resistance, maybe 0.6580, 0.6660 area.
Right. These are just potential scenarios, of course. And for a week like this, risk management has to be front and center. Let's talk global news.
Absolutely critical. Rule 1. Before a major event like NFP, maybe consider reducing your composition size. This just helps limit your risk from potential slippage or spreads widening suddenly when the news hits.
Good point. Don't get caught by surprise market mechanics.
Exactly. Rule 2. During the event release, try to avoid rushing in immediately. Markets often overreact initially. You see these sharp spikes and then reversals, V-shaped traps. It's often better to wait, maybe 15-30 minutes, let the dust settle a bit, confirm the market's direction on shorter time frames, maybe look for a pullback entry.
Patience is key.
Definitely. And rule 3, use smart stop losses. Don't just pick an arbitrary number. Base them on meaningful technical levels below support, above resistance. And just be aware, around big round numbers or key pivot points, you can sometimes see stop hunts, where price briefly pushes to trigger those stops.
Okay, really practical advice there. So wrapping this deep dive up, you can really see the week ahead is set for this intense mix of crucial data, shifting central bank expectations, and that very unusual market positioning we explored. It really demands focus and understanding the currents beneath the surface.
Precisely. Understanding these dynamics, hopefully through deep dives like this, helps you be genuinely well-informed. It lets you prepare, navigate the potential volatility with a clearer view, rather than just reacting to headlines after the fact.
So as we've laid out the forecasts, the position, it leaves us with a final thought for you to ponder. If the market is leaning so heavily one way, and some of this week's data contradicts that crowded bet, could the sheer volume of catalysts trigger a chain reaction, a cascade, that reshapes the market landscape in ways very few are actually predicting right now? That's the kind of unexpected dynamic that always keeps things interesting. We'll see you next time on The Deep Dive.